Good morning, good afternoon, and good evening. Thank you for joining us today on behalf of Jada Real and Moss Adams. To begin, my name is Wenbo from Jada Real China Desk, and I will be the moderator for today's webinar, Investing in North America, Mexico, and US 2025. This webinar will last 60 minutes, including the Q&A session at the end. If you have any questions, you can type that in the chat box. So today in this session, you will gain insights into the key considerations for companies looking to do business in North America. Our experts will discuss the oncoming USMCA review, the impact of the new government regulations in both countries. We are honored to have four distinguished speakers joining us today. Cynthia Yanis, China Desk Industry Lead Partner from Jade Real. Antonio Avila, Foreign Trade Partner from Jade Real. Lu Zhang, Principal International Tax from Moss Adams. Mitch Bailey, Tax Senior Manager from Moss Adams, and myself from China Desk, Jade Real. So Cynthia Yanis has over 15 years of experience advising international clients from different industries operating in Mexico. She has helped many international, especially Chinese companies with their successful soft landing into Mexico from the initial steps of analyzing Mexico venture until the company begin able to perform their day-to-day operations. Antonio Avila, with over 20 years of experience in foreign trade, Antonio has advised companies such as IBM, HP, Honda, Toyota, Puma, Cuervo, and Samsung, among others. He is a speaker and trainer on foreign trade issues at national and Latin American levels. Lu Zhang has been providing international tax service since 2006. Her work focused on optimizing worldwide effective tax rates through tax-efficient financing, cash management, supply chain, and transfer pricing strategies. Mitch Bailey has practiced public accounting since 2016. He primarily assists clients with state and local indirect tax matters. He works with clients in the software, technology, telecommunications, airspace, and insurance industries. Now let's go over the key topics we will be covering in today's webinar. So today we will talk about oncoming review of USMCA, Mexico and US perspective, new investments from forms of operation in light of new government, recommendations for doing business in US and Mexico, industry sectors of interest in US and Mexico, and tax considerations. And in the end, we will have a conclusion and closing. So I will pass the microphone to oncoming review of the USMCA, the Mexico perspective. Cynthia, please.
Good morning, good afternoon, and good night for everyone that is joining. We are so happy for you to give us a little bit of your time today for these interesting subjects. And the first item that we are going to start reviewing today is the USMCA, in specific, the Sunset Clause. I think everyone, we've been hearing in the news that the USMCA has been put in review. So we will discuss that. But first, I would like to say that USMCA is a free trade agreement between three countries, between Mexico, US, and Canada. So it's a three-party agreement. In United States, it's known as USMCA, and in Mexico, we also know them as TMEC. In Canada, they also have another reference for it. So this agreement, this free trade agreement, has a little bit of background because this USMCA, as we know it, substitutes the previous NAFTA agreement. NAFTA was the previous agreement between the three countries. this was in force in 1993. So with this new USMCA, the three parties wanted to adjust certain clauses, specifically some of automobile industry. There were some adjustments related to salaries within the three countries. So they wanted to adjust the relationship, and that this USMCA was in force in July 1st, 2020. One of the difference of this agreement is that it included a review clause or a sunset clause. And this is what is happening right now, is that initially this treaty was created for 16-year term, right? So from 2020 until 2036. However, they included some periods on which the three countries will gather to review how the new operation has been doing between the three countries. So the first period for review of this free trade agreement is July 1st, 2026. There will be another review in the following 6 years, which means July 1st, 2032. So what is happening right now is we are going to start the period for the first schedule review of the agreement. The possibilities are that the countries can amend some of the clauses. That is one of the possibility. Another possibility is that they agree and opt to renew for 16 more years, or the one of the parties can claim that they do not want to participate on it and therefore will only be valid until the original date, which is 2036. However, we wanted to let you know that this process of review between the three countries is according to schedule, and we will see how negotiation goes between the three parties.
About the status of the Mexican consultation about the renewal of the USMCA, it's important to consider that the last year, the Mexican president, Claudia Sheinbaum, shared the team that it's going to start reviewing the different topics of this treaty. So there are different CEOs, directors, and leaders of chambers that are part of this big team that the name is CADER, that we are going to start reviewing the USMCA the next July 1st of this year. So the principal interest of this team is related with the automotive sector, China, and rules of origin, among others. So that's part of this new negotiation that we are considering to review these kind of topics the following months.
From the U.S. perspective, in preparation for the next year's review, the U.S. has started public consultation. Many observers and political analysts believe that the Trump administration will likely withhold U.S. renewal approval to compel renegotiation on certain terms. As we know, that the Trump administration recently implemented new tariffs, which Antonio or Cynthia is going to introduce in more details on the next slide. There are additional tariffs that potentially can be implemented on automobile imports that can take effect as soon as April 2nd, 2025. This new proposed policy can potentially override the 75% North American content rule, which triggered objections from the trade groups.
So thank you. We will go to the next topic, new investment from operation in light of the new government.
I'll start when yes, and because it's possible that we expect some modifications due to the renew of the treaty. Mexico, from its own side, has been preparing in order to continue to maintain the new investment levels as in prior years. Therefore, our new president, she created the Mexico Plan, and we are going to be hearing about it. It is called Mexico Plan, the document that she delivers, and this document is a strategy to maintain s- uh, s- sustainable growth during the 6 years that she will be in power from 2024 to 2030. So they created like 10 different areas that Mexico is going to be promoting or developing in order to receive and maintain the foreign investment that will come into the country. So this Mexico plan, it's a series of steps for the sustainable growth. And these steps goes into, I believe, an integral area. For example, they talk about long-term development of Mexico as a country. They want to promote relocation of the companies and manufacturing entities. They want to increase, and this is, I think this is very important and key for new investment. They want to increase the content of national product or regional product by substituting imports from another country. As long as Mexico's investment, they continue to play by the book or by the rules, I believe this is a very important matter. They also are interested in generating well-paid jobs. So we are going to see a lot about technical training, scientific training, and also they want to promote technological development, innovation. So we are going to see different actions towards that. Um, this Mexico plan, it's the president working with different institutions, like you can see right here. The first one, Economia, is the Ministry of Economy. This is key player in new investments coming to Mexico. The second one is SHCP. This is our Mexican Tax Authority, of another key player in investments growing in Mexico. And then we have other entities that will grant different different licenses to the company, such as any health or any other norm that needs to be regulated. We see CADER here that Antonio already mentioned. Uh, these these new investments that Mexico will receive in the following year, they can already have some of the effects of this Mexico plan. One of these is a nearshoring decree. We are going to be talking about it. The nearshoring decree is incentives created for new investment into Mexico. So we will see the details of that shortly. We also have soon to be released IMEX 4.0. This is a new version of the IMEX program that many companies are familiar with, and the authorities are also bringing back the Made in Mexico stamp. So this is something to recognize that certain products uh, comply with the requirements, and they can be considered to be made in Mexico. So we're going to be seeing a lot of that, and also know that Mexican authorities are working very closely with new investments. They say they are the authorities and the different cities in Mexico are having monthly meeting to validate how they are speeding up processes. So we can see that Mexico is preparing for the new investments to have a good experience coming into Mexico.
Thank you, Cynthia. So, the one of the hot topics or the principal topics related with the trade that we have between Mexico and United States. As you know, it's the change of the tariffs. So, as you know, when on February 1st, we have a executive order from President Donald Trump, and he shared that some of the ways that we are going to consider in the relationship between the two countries, it's probably to have new tariffs. So these tariffs that are proposed, there are 25% to all the products that are going to be sent to the United States. Um, it's the day that it was to start this new tariff change. It was suspended, and it's going to be the day that we are going to have this new regulation is March 4th. So in meantime, the authorities are reviewing some specific topics in the relationship between United States and Canada, and United States and Mexico. And with this negotiation, probably this a specific date it's going to be changed. We don't know. We need to wait until be more close of this specific date. And uh, also, it's important to mention that in the relationship with China, also it was added a 10% of the tariffs of all the imports from the Chinese origin to United States, and it was effective on February 4th. So also we are going to have another products that they are going to have tariffs, for example, aluminum and steel, that it's probably they are going to start these new tariffs of the 25% on March 12th. So that's of the way that we are working with this trade war that it's called in the news.
With respect to China, in the same executive order that imposed the additional 10% tariff, the de minimis exception for imports from China was eliminated. Because some of the operational challenges, the administration paused the enforcement of the repeal on February 5th, temporarily reinstating the 800 de minimis exception. So there's an additional uncertainty here.
Thank you, Lou. So considering the possible reaction of the Mexican authorities, we have a plan B that it's called from the Claudia Sheinbaum, the president of Mexico, that it includes two principal topics: tariff per tariff. What it means that duty per duty. If the United States impose the 25% of tariffs, probably Mexico is going to have the same tariff, but with a specific products. And also non-tariff measures. There are some regulations that probably the Mexican authority can start after when we receive this 25% of from United States. It's important to know about the past, the background in the relationship between the two countries, that in the year 2018, we have the similar action from the Mexican authorities. So in this specific year, it was imposed a tariff for the steel and aluminum, and the reaction of the Mexican authority is to impose some duties, some tariffs for agricultural products and also steel products and other consumer goods. For example, the whiskey and apple, these kind of products, they have new tariffs. So it's probably we are going to have changes in the tariffs if we have if we continue working in the same way, tariff per tariff. Okay, so there are some mitigations strategies that we can consider for the Mexican side. As you know, Mexico have some programs that can help the companies for not have some benefits. For example, in Mexico, we have the PROSEC program that if we are a company that produce in Mexico and we are in a list that of the um, Ministry of Economy, we are going to have some special duties, preferential duties that we can use when we import to Mexico. So we can use this kind of programs, also the IMEX program for the companies that want to make some maquila in Mexico. Also, we have we can review the evaluation of the goods, to review the royalties and also tariff classification and the origin of the goods that are one of the principal topics that we need to be focused in the next weeks, because it's going to be very important to know the real origin of the goods, because we are going to have different tariffs for different origins.
From the US perspective, there are certain strategies that are similar to what Antonio just mentioned. For example, changing transfer pricing method and separate royalties and services to lower the valuation. Those are effective strategies. In addition, companies may consider taking advantage of the bounded warehouse and US foreign trade zones. There are also government tariff exemption and drawback programs that companies can apply. Last but not least, companies can consider modifying their supply chain and consider moving their manufacturing activities to the US.
Thank you you all. And next, we will review the topic of recommendations for doing business in US and Mexico.
We all know that President Trump has proposed lowering the corporate income tax rate from the recent 21% to 20%, maybe with further reduction to 15% for companies that manufacture within the US. Currently, there are several tax incentives and credits already in place to motivate domestic activities. For example, in here on this slide, I list research and development credits, energy-related credits and deductions. Those incentives and credits are generally available to both domestic and foreign investments in the US. In addition, there is an export incentive called Foreign Derived Intangible Income, or FDII, or FDII. Some practitioners call it FDII deduction. It is a special deduction for sales and service income generated from foreign customers. For example, a US company providing research and development services or sales and marketing services to its foreign parent company can potentially qualify for this special deduction. So with that, I'm gonna turn it to my colleague Mitch to talk about some state-specific incentives and benefits.
Thank you, Lou. So in addition to some of the U.S. federal income tax considerations that Lou was speaking to, I also wanted to take a few minutes to share some considerations from a U.S. state and local tax perspective. As many of you may be aware, the state and local tax landscape in the United States is fairly complex, with 50 different states as well as many localities that is separately impose their own tax and fee regimes. So starting from the sales and use tax perspective, so 45 out of the 50 US states impose a sales and use tax, plus the Washington District of Columbia. And so those those sales and use taxes are generally imposed on purchases of tangible personal property and certain services. While the specific rates can vary quite substantially depending on the specific local jurisdiction that you're in, the combined state and local sales and use tax rates generally average between 7 to 10%. So in the context of investing in some sort of facility within the United States at that 7 to 10% rate, multiplied by your investments in tangible personal property, obviously that sales or use tax burden can become quite substantial. However, in the context of manufacturing companies, most states have some avenues to have pretty substantial savings on that sales tax burden. So 43 of the 50 US states offer some form of sales and use tax exemptions for manufacturing machinery and equipment. The specific criteria for what does and does not qualify can vary some depending on which state you're operating in. But some of the similarities, kind of the overarching themes that states have in common are, it's items that must be purchased by the legal entity that will be performing the manufacturing for use at a manufacturing facility within that state. Another common criteria is that the items that qualify for the exemption, they must have a useful life of greater than 1 year. So this limits it to, more of your capital investment, whereas certain supplies and consumables that get used up in the manufacturing process would not necessarily qualify. Another consideration to keep in mind when pursuing these types of exemptions is that most states generally require that the manufacturer be registered for sales tax in the state where they're planning to claim the exemption, and also require that they furnish documentation, what's called an exemption certificate, to their vendor to document the exempt nature of the transaction. And absent that documentation, the exemption generally would not apply. All that being said, again, these types of exemptions are available in 43 states. Some states have a fairly narrow focus, whereas others are quite generous and extend the exemption to any tangible personal property, so any equipment that touches raw materials or components at any point during the manufacturing process. Another positive trend related to these exemptions is that historically they were limited to companies that were manufacturing items for retail sale or wholesale sale. In more recent years, we've seen several states trend towards extending these manufacturing machinery and equipment exemptions to machinery and equipment that is solely used in R&D operations. So to sum that all up, as many of you are aware, the types of machinery and equipment that you would purchase to build out a manufacturing facility in the United States can be quite expensive. And with an average of 7 to 10% sales tax rate, the potential savings via these exemptions can be quite substantial. I also wanted to take a few minutes to speak towards a few relevant state income tax considerations. Another positive trend that we're seeing in the state income tax space is states that are trending more towards single sales factor apportionment. So for state income tax purposes in states that impose their own income tax at the state level, the measure of tax is your apportioned federal taxable income. And historically, states would use a 3-factor apportionment method that considered your payroll in the state, your property in the state, and your sales in the state. Because of that old apportionment method that was used, manufacturing companies that are tend to be very capital intensive and also very labor intensive would end up with disproportionately high apportionment percentages in those states. However, over the last 10 to 15 years, we've seen a trend where now the majority of states use single sales factor apportionment. So the apportionment percentage is focused only on your sales activity in the state, which levels the playing field quite a bit. There are some states that are still using three-factor apportionment, not very many, but this can be an important planning to consideration when looking to make that investment in the United States. That may help you. This is a relevant consideration in terms of which specific state jurisdiction you locate your manufacturing facility in. One final item that I wanted to touch on is related to depreciation. So state income tax depreciation, depending on the state, may or may not follow the specific rules of federal income tax depreciation. But in the context of building out a large manufacturing facility, there may be an opportunity to do what's called a cost segregation study, which allows you to look at the individual components of a building and apply a shorter useful life to certain components, as opposed to depreciating the entire building over a 30-year life. And this allows you to accelerate some of that depreciation and result in tax savings in the near term. And with that, I will turn it over to the next speaker.
Thank you. So now to go over the Mexico side of things, we continue to incentives about investment in Mexico. And we are being reminded of Mexico Plan created by our president. One of the actions of this plan is to release the nearshoring decree. This nearshoring decree was published on January 21st, 2025, so it is a rather new incentive decree. It includes some incentives again for new investments in Mexico. What the authority is looking for with this is definitely to promote investment. As we have mentioned before, they are looking for companies to invest on training programs for the employees. So we're going to see benefits related to that, and also for innovation. So those are the areas that will be benefited by this. So one of the main benefits of this is we can have immediate deduction or accelerated deduction, as Mitch mentioned for the US, of new investment in fixed assets. So here there are some exemptions. For example, this is not included to furniture and fixtures or to gas vehicles, but anything else like machinery, construction, those type of capital expense that you have when creating a new facility in Mexico. Just to put an example, a certain type of machinery can be depreciated 10% each year. So it means that it can take over 10 years to take full deduction of the asset. In this case, we can see this accelerated depreciation. It's pretty detailed, so you will need to see which type of asset you're looking for to see where you fall into, because there are specific rates, but accelerated rates, but usually they will be between the 56% and the 89%, which in all cases is an incentive versus a regular company. As we have been discussed, the highest percentage, the 89%, for example, is for high technology and development sectors. A good thing about this nearshoring decree is that we used to have something similar in the past. Now, with this new decree, it does not make a difference between if it is a Mexican entity or is a foreign entity. It also does not make a difference between industry, meaning that it can apply to all industries. And what they are looking for, the authority, is that the benefits can reach a larger number of entities because they are opening this to national and foreign companies and any type of industry. There is another benefit that it's not included in here, but as I mentioned, they are looking for increase in technical training for the employees. So there is a 25 additional deduction of your increase in training expenses. This means that whenever, if you have an increase versus what you have paid in the previous years versus what you're paying in 25 until 2030, you show an increase in that line of expenses, you get additional 25%. So I think this is good. This shows an effort for the government to try and promote the technical training of the employees. They mentioned that they are going to be having a committee that will evaluate the companies that are on this decree, and for budgeting measures, they are expecting to spend 30,000 million pesos, which in USD is around 1,500,000 million USD. So this is what they are planning to give during the 6 years of the plan until 2030. So I think definitely is something good for new companies that are planning to consider in Mexico. Uh, we should hear about the specific regulations in the following weeks, because they will release the requirements and how to request these benefits. But I think definitely this will increase investment, and will increase the intention of the employer to invest on the training of the employees.
Continue with the changes that the Mexican authority is sharing. It's important, or the one of the biggest topics is related with the IMEX, with the maquila. As you know, the 60% of the exports that Mexico has every year are related with the IMEX company. What it means that um, the principal sector that it's exporting in Mexico is the IMEX companies. So considering that it's the biggest sector that um, we can use to promote the new investments, and the authority considers that it's necessary a change. So this change is called IMEX 4.0 or 4. That it means that we are going to have some new benefits that we didn't have in the past. For example, um, the principal benefit of, or one of the principal benefits of having an IMEX program, as you know, when we request an IMEX program, we need to go with the Secretary of Economy, and then they are going to provide this new program. But also we require a second authorization that it's called VAT certification. With both authorizations, we can have benefits. For example, not paying VAT on temporary imports in Mexico, that is the 16% of VAT. So we have this benefit, and also with this kind of benefits, they can help us with the cash flow of any entity. So this kind of benefits knows the authority, and they are going to change some rules. For example, if we request both authorization, like I said, VAT certification and the IMEX program, we need to wait like probably the real time, like 8 to 10 months to have both authorizations. So the authority is sharing that we are going to have the less time to obtain both authorizations. They are sharing that we are going to have the 50% of the time to obtain this kind of authorization. That's good news, because we can start the operation of a IMEX company in a less time. So also another benefits that we are going to have with the IMEX Ford, it's related with the trusted profiles. What it means that they are going to evaluate the risk of the operation of every IMEX company. And if we are a trusted company, we are going to have more benefits in the operation. So, for example, benefits with authorization in Mexico, we have some permits that we can use. For example, Rule 8 that is pretty common for not paying duties on imports if we are a producer. So we can obtain these kind of benefits. Also, another benefit related with this IMEX, it's that we are going to have a special treatment for the semiconductor companies. In other words, they are going to provide more benefits to a specific sectors like these high-tech technologies. So if we are in this supply chain area, we are going to obtain more benefits related with the high-tech products. So that's good news for this sector. And we need to wait the following weeks to review the draft of this new IMEX 4. Probably in the final of this month or probably the next month, we are going to have the text, the draft of this new IMEX 4.
Thank you, thank you. And now let's shift our focus to industry sectors of interest in US and Mexico and tax considerations. I will hand it over to Moss Adams.
Here we have a list of industries and sectors. And so I picked some of the key sectors of interest for foreign companies investing in the US. We're based in the San Francisco Bay Area. For California, I believe the top three industry for foreign investments are technology, manufacturing, and life science. But we do have clients from other sectors. For example, we have digital asset companies, and we also, of course, have like the real estate and infrastructure companies as clients.
Thank you, Lu. I can take over for the Mexico side. So here in Mexico, there's also, well, authorities have been more formal about it, and they have identified sectors of interest for Mexico. How they were identified, it's whether the authorities are interested in expanding an existing sector already, or they want to increase or they want to create a new productive activity in the country. And again, they want to create this Mexican supply chain force so that we can substitute imports by local suppliers. So we can see here we have 10 sectors of interest that Mexico has called. We have semiconductors, energetic, tourism, infrastructure, and so on. Many of them are created as a sector they want to improve because they generate new jobs. They in some way can combat the climate change, and also we can have diversity of economy. So besides of doing this identification, if we could see the map, we could see where these industries are located in the country. And what the authorities are doing next is that for each specific sector, like semiconductors, they are creating different benefits. Right here on this presentation, you can see at the bottom, it says benefits to be published. So these are the steps that authority is considered for each sector. You will see something different for energetic, you will see something different for tourism, but to give you an idea, for example, SAT, which is the Mexican Tax Authority, in one of the sectors, they are considered to give immediate VAT refund for companies that can demonstrate local supply that's high as 40 to 80% in specific sectors. So if this benefit is published, I think this will be very important because if you can have a good enough local supply, I think you can also get in return the cash flow for the VAT that you have paid. And uh, another authority, which is the Ministry of Economy, they are also giving different incentives for these sectors. I don't know, Antonio, if you want to touch this a little bit.
Sure. One of the benefits that the authority of the Ministry of Economy is going to share in the following weeks, it's related with the Rule 8. As you know, the Rule 8, it's a permit that every producer, every company that producing in Mexico, that manufacture in Mexico, can request a benefit of not paying duties on imports. So this kind of benefit we can obtain if we work in some of these specific sector, for example, semiconductors, the sector of electronics. So, and another benefits are related with the permits from steel. So it's going to be easier to import steel just for specific sectors. As you know, we have some permits, some authorizations that we need to do in order to import this kind of products. And also, the authority is going to review another benefits for this kind of sector. So that's pretty important to wait to this new publication from the authority, but there are good news for the people that we work in the foreign trade area, because it's pretty difficult to obtain, for example, Rule 8. So if the authority says that it's going to be easier to obtain a Rule 8, yeah, that's good news for manufacturing companies.
Thank you, Tonio. And I would like to make one more comment on this. Through this research that we were doing to prepare this webinar, I found out that one of the items that the authority is doing is to expedite more the resolution of these licenses like IMEX or VAT certification. That alone will be beneficial for the companies investing in Mexico because they do not need to delay their project. So if the authorities can respond with increasing response time or expediting response time, I think that's going to be pretty significant.
Yeah, I would like to add that in some cases, companies are waiting like more than 1 year for some authorizations, and so if we have a faster answer from the authority, that was good news for everybody.
I also want to make a clarification. I said when I covered the sectors of interest for the US, I said for California, right? But just want to clarify, Mitch and I are based in the San Francisco Bay Area, but we have offices in more than 30 locations. And so most of the federal and state incentives and benefits that we mentioned are available for most of the industries on the list. So like R&D credits and energy-related incentives, and the FDII applies to most of the industries.
Thank you. Thank you for your presentation. I don't know, Mitch, if you have any comments.
Yeah, I guess one last comment that I would add on to what Lou said is yes, we have locations in over 30 different locations, and we have people who are experienced working with all 50 US states.
Thank you, thank you. So the next part is the closing and the conclusion. I don't know if you have some recommendations for today's audience or for the people are going to have investment in the US and Mexico. I don't know if you have some recommendations. Let's go start with Mos Adams.
Okay, I'll start first. My 2025 recommendations, I would say because of the uncertainties, right? The frequent development, I would say just be proactive and plan early. As I mentioned, I think I would recommend companies to reevaluate your legal entity structure, supply chain, intercompany transactions, and your transfer pricing policy. I think those are priorities, and by planning early and know your structure and know your policies, then you can take actions accordingly and to minimize the impact. Potentially can be resulted from the new changes.
I think what Lou said is a great point. The earlier you plan ahead, I think the more options that you have, and it's great to get in front of those considerations early, especially both at the federal level and at the state and local level. And I guess the only closing thought that I wanted to add, obviously there's a lot of uncertainty at this point, and a lot of discussion surrounding tariffs at this point, but keep in mind the U.S. is looking to increase investment, and states are looking to increase investment in their state jurisdictions, and there is a lot of opportunity out there, especially on the sales tax side. The M&E exemption that I shared earlier is just one of those considerations, and just kind of looking at that list of industry groups, many of those industry groups have specific sales and use tax considerations that states are using to try to incentivize investment in their state. So opportunity is out there.
I think Lou's and Mitch comments, I think they are very on point. Definitely plan ahead. That would be number one. And two, I will say to the audience that we're hearing and reading many things right now, but I'm afraid we cannot have one answer for one definitive answer for everyone. With the conditions right now, everyone needs to go case by case. And what I mean is that your product needs to be analyzed, whether it can be covered by the USMCA or any of the other incentive or promotion programs that we have, like IMEX or PROSEC or so on. So definitely reach out to your advisor, because I think there could be a way for everyone that's planning to do business in Mexico or Latin America.
And finally, I would like to add that it's necessary to review case by case. As you know, there are some benefits that we have with the treaty, with the USMCA. So as you know, it's going to be a revision, a review, and it's not closed, the USMCA. So it's important to be part of this region, of this area. So we need to wait for the new rules. We are going to have the new rules, and it's going to be everything in the same way as in the past. So we have been working in the three countries, Mexico, United States, for more than 30 years in trade. So it's not going to be closed because there are many interests in every country to continue with this treaty.
Thank you, you all. So as we said, this presentation is based on some general and public information. If you have some concern or some questions, please feel free to contact us, and we will analyze case by case. So I think I'm with some interesting questions. Okay, I have a question very interesting. Do we have any formula to calculate and demonstrate this 40 to 80 local supply? I believe this question can be best addressed by, I don't
That would
know.
be me. Yeah,
Okay.
I did mention that. Yes. So currently, no. And this was on the screen that was talking about the sectors that the authority was going to be promoting into Mexico. This is one of the items to be released. Yeah, so the authorities have mentioned right now these are the sectors they want to promote, and these are the benefits that they are contemplating to grant. However, right now we do not have the specific rule, the specific benefit. We believe that in the following weeks we should start hearing about it. And because every step of the Mexico plan, the president has been very active, so maybe we hear something about it soon for each of the sectors. Remember that it was not applicable to everyone, the specific sectors.
Thank you. Thank you, Cynthia. We have now reached the end of this webinar, but I can see someone still have some questions. As you can see in this slide, we have the email of each contact: Cynthia, Antonio from Hoda de Rio, myself from Hoda de Rio, Lu Zhang and Mitch Bailey from Moss Adams. If you have any questions, please feel free to contact with them. So on behalf of Jada Rio and Moss Adams, we sincerely thank you for your participation. We remain at your disposal for any questions or advice you may need. Please feel free to contact with us. The emails displayed on the screen. See you soon and thank you very much. Have a nice day. Thank you.